Hi folks, in today's episode, I'm going to talk about NFOs, that is new fund offerings in mutual funds. What are the advantages and disadvantages and how an investor could possibly go about assessing them. So the Indian markets have done well and investors have reaped the benefits if they've been invested for 2 years or more. But the mutual fund houses have not been idle at this time. They've come out with many new funds over the last 2 years. In 2023 alone, there were about 200 odd new funds which were released, out of which 100 were equity funds, and of these 50% were index funds, but a lot of new funds which are actively managed also were launched. Now, investors often are sold NFOs stating that they are cheaper because the net asset value is only 10 rupees. But this really does not matter whether you get it cheaper or more expensive by whatever metric you're measuring. It is the rate of return on your investment which really matters, considering all other things to be the same. So let's look at this calculation here. I've taken an example of an NFO vis-a-vis an existing mutual fund. Now the NAV or the price per unit is 10 rupees, which is typical for an NFO. Whereas for the existing fund, I've assumed that the price is 100 rupees. Now, while per unit the cost is cheaper, but you must remember that you're investing a certain amount. So whether it's a new fund offering or a existing fund, you'd be choosing an amount to invest in, where in this case I've taken 10,000 rupees. So when you invest 10,000 rupees at the rate of 10 per unit, you get 1,000 units. Whereas in the existing fund, since you've invested at the rate of 100 rupees per unit, you're getting 100 units. Now let us assume that after 1 year, the NAV of the existing fund went up to 12 rupees. And the NAV of the existing fund, that is the old fund, went up to 120 rupees. What does this mean? That the value of your investment in the NAV, which was 10,000 in total, has gone to 12,000 rupees. And in the existing fund, it has gone from 10,000 to 12,000. So the rate of return is the same. Whether you got the per unit price cheaper or more expensive, then also there was no benefit because both investments return the same. That is at the rate of 20%. Now, in this example, I've tweaked it a little bit. Let's say the NAV of the new fund went to 11 rupees after a year, but in the existing fund, it went to 125 rupees. This means the NAV has given a return of 10%, whereas the new fund has given a return of 25%. So in this example, you can see that investing in an existing fund would have been more beneficial for the investor than investing in a new fund. It could be vice versa also, where the new fund has given more than existing. But I just wanted to demonstrate here how the price per unit being lesser in an NFO does not mean that it is an advantage for investors. This is very important for investors to understand. It's also the reason why a lot of people who want to buy stocks prefer stocks which are cheaper. They may have a threshold that is less than 100 rupees or less than 10 rupees, and therefore it's cheaper and the chances of making more money is higher. This is not true. Even in stocks, it is the inherent value of the company, the performance, the profitability, the industry, which is in a whole host of factors which go into moving the share price up or down. So this is the first point when it comes to an NFO. Now the NFO can be into broad categories like a large cap fund, a multi-cap fund, a small cap fund, a mid-cap fund, which are essentially diversified mutual funds, or they can be into a particular sector or a theme. Again, here it is important for us to assess the possibility of return from a new fund. Now, let's say, for example, a fund is getting into the large cap space. there are a plethora of funds which are more than 5 years old. There's a wealth of data available to you on their performance over so many years. Now, in the large cap space, there are only 100 stocks which the fund manager can consider while investing. So, how much of differentiation can a fund manager do with a new fund? So, this is what you need to consider. By getting into a new fund, is there a significant advantage that you're getting over a existing fund? If not, then is it not safer to go with a fund which already has an existing track record? This is very true in the case of diversified mutual funds or which are in regular categories like the ones I mentioned before. Now, you could also be looking at a sectoral or thematic fund. Here, investors are cautioned to be very careful simply because these are funds where the fund manager necessarily has to buy into the same sector or theme, whether the sector or theme is doing well or not. For example, infrastructure funds were languishing in the years between 2010 to 2015 or more. People who had invested there hardly saw any returns. But you can imagine that the fund manager did not have a choice of moving out of that sector simply because they had committed to us, the investors, that they are going to focus on the infrastructure space. Whereas a diversified fund manager, if they had investments in the infrastructure space in 2010, could have very well taken a call to move out and put the money somewhere else, thereby investing into better performing stocks which are in better performing industries. So you see the risk in a sector or a theme. Now again, you could be bullish about that sector or that theme, but you may find that there are already funds which are existing in that space. So what you could do is you could take a comparison between a large cap fund, which is your baseline fund, either a Nifty 50 fund or an actively managed fund. Then take the existing funds which are in that sector or that theme and compare against it on a 3, 5 and 10-year rolling returns. This will give a clear picture as to past performance of the sector. It could be that the fund itself has not performed well due to the calls taken by the fund manager or due to that sector not performing the past so many years. These are factors which you will have to assess. But assessing the data of existing funds in that sector or theme could be a good place to start. Be careful when you get in and out of a sector, because that call will typically have to be taken by you or somebody who is guiding you. They need to be really knowledgeable about the sector. Else, you may enter in at a high and see that the sector is languishing for a long time. So I hope this helps you to figure out which funds to invest in. If you're not a very savvy or a high risk investor, it is always best to stick to the diversified mutual funds. Start with large and flexi cap funds and then work your way towards mid cap funds and small cap funds if you're comfortable with it. So if you have any queries, or do drop a comment and we'll be happy to get back to you. Thanks for watching.